Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me again, the man himself, the governor of the great state of real estate in Texas, Mr. Michael Becker. Michael, how are you?
Oh, yeah, things are going pretty good. It's kind of back from the conference circuit, trying to get some deals going here in the first quarter. So how are things in your world?
Lovely. So you just came back from the Super Bowl. How was that? That's a bucket list for all of us. Would you recommend it? Did you enjoy that?
The game wasn't the best, and the halftime really wasn't my cup of tea, but it was a cool experience, and it was a little easier to get around and get into than I kind of was expecting. There was a bajillion metal detectors everywhere, so they had it pretty efficient to get in, and it was definitely a cool experience and something to see. So I'm glad I did it.
Did you see any celebrities? Did you have binoculars to look at the president over there, or were you trying to check out Taylor Swift?
We walked right by James Carville and his wife, Mary Madeline.
That's it.
They were right down on whatever Bourbon Street or whatever, walking right to the Superdome and walked right by James Carville, and he had his Nova shirt on. So that was my first celebrity sighting of the trip, I guess.
Well, I don't know if you'll see any celebrities at the Old Capital bus trip coming up here at the end of March 28th. Go to oldcapitalpodcast.com and come on with us. Let's kind of show you a little bit about what's going on in multifamily. If you're brand new to investing, before you spend $100,000 or $200,000 investing in an opportunity of multifamily, come out and take a look, and where the rubber meets the road, we'll show you a little bit about what it's all about, what it's done for the last, say, 10 years, what's done for the last, I've been doing this for 38 years, so what's been going on for 38 years. We'll show you some properties that we financed, how they were structured, but you'll have an opportunity to walk through a lot of different Class B and C properties in North Texas. So regardless if you're going to invest in Florida or you're going to invest in California, the math is the same. 1 + 1 = 2 across the United States. The first step is coming to learn just some of the basics and then take it back to your market just to learn a little bit about multifamily investing. So go to oldcapitalpodcast.com and come visit with us coming up March the 28th. In the podcast today, we're going to be talking to two friends of ours that we've known for quite a length of time, and they're going to tell a little bit of their story about getting and being in investment sales. A gentleman that I've known for a long time is a gentleman named Zar Haro, and Zar just came over from another investment sales group over to our friends over at Colliers. And then another gentleman, Bob.heard. Bob has been with Colliers for a number of years, and we're going to talk a little bit about the donut hole in the donut, because we always typically talk about Texas, but we always kind of specialize in North Texas and Dallas. But we're going to talk a little bit about Houston, and we're going to talk a little bit about San Antonio and Austin, and how these two groups, Zar and Bob, they've come together to form kind of a partnership. And we want to kind of talk a little bit about that and give people a little bit of the meeting of the minds, the energy that these guys bring forward, and when they're looking or selling an apartment building in that part of Texas. So in the podcast today, I want you to say hello to Zar Haro. Zar, how are you?
I'm doing great. Excited to be here again as a new guest again. And we're excited, and I'm excited to bring Bob on as well.
So Bob, say hello. Bob.heard with Colliers out of Houston.
Hey, this is Bob Heard out of Houston at Colliers. Excited to do my first recorded podcast.
That's great.
Looking forward to seeing how this goes.
Okay, I'm going to turn it over to Michael. Michael, let's start talking to the guys.
Yeah, I thought we was kind of maybe a little quick kind of state of the market conversation. Maybe we'll start with you, Zar. Kind of you're based in San Antonio. Maybe a brief little background on yourself and kind of how you recently new team member over at Colliers, starting up their Central Texas office. So maybe a quick little background would be helpful.
Sure. My name is Zar Haro. I've been in the business 20 years doing investment sales in Central Texas. My first job was a mortgage intermediary, and then did investment sales after that. I've been with some of the biggest name firms in the country, but we're excited to be here. It's the blend of, for us, institutional capital as well as private, and a true blend and a very entrepreneurial culture where it's very much the producer forward, and then the Colliers brand is here to help us. But what I would say is exciting about Central Texas is for new entry capital, it's a great moment in time because NOIs are distressed, operations are distressed, entry points very similar to what 2008 was. And, we have these moments in time where we look back and say, well, yeah, if you bought anything at that moment in time, well, yeah, it was an obvious moment, but obviously obvious moments, not everybody shows up because they're dealing with either problems in their portfolio, they're dealing with partnership dissolutions, they're dealing with capital constraints. What we find is the entry points in Central Texas, because both Austin and San Antonio are experiencing operational challenges, but those challenges are oftentimes the hidden gems where properties near and adjacent to one is operating at 95% occupancy, growing rents, and delivering great quality product to tenants in the marketplace, and the other one suffering next door. So it's being able to navigate in the moment and having confidence that eventually things come back. But that's the moment of the opportunity for Central Texas, is reinvesting back in a moment where things feel tough. But, the J curves usually will say that when you're entering at a challenging time, the moment to enter is actually now to feel more confident, because your exits are usually a lot more strategic and safer than when the money's always flowing. So if you can raise capital in this part of the world, you should feel confident in your abilities to have the best vintage exits, whether you're a fund model or individually raising. Is the years of 25, 26, and 27 are probably going to be the finest vintage acquisitions.
Easier said than done, huh? So, Bob, the opposite is probably Houston right now, where, we don't own Houston at my company for various reasons, but it seems like Houston probably has some of the best fundamentals of any market in the Sun Belt. So maybe a quick little background on yourself, and then, what's kind of your thoughts on Houston right now, kind of big picture.
Sure. So like Zar and many of the rest of y'all on here, we've all been in the business a long time. I think I'm coming on 17 years of investment sale brokerage with a little stint on the principal side, and joined Colliers about 5 years ago now. Love the entrepreneurial aspect of it. It's a brokerage shop, an investment brokerage shop in the truest form, whereas a lot of the other shops are more mortgage banking shops that have brokerages. So I like that aspect to it. Yeah, this is, as Zar mentioned, Houston, very similar. We had a lot of run up in basis over the last number of years. And when you go to enter Houston, this would be a great time. And this is what I believe to be true, is another period where, and I went through the Great Recession as well, and we look back and say, hey, if you bought it then, you're good. That seems to be, we're in one of those windows as well. Fundamentally, well-operated and well-capitalized groups in good submarkets are doing just fine in Houston, and that's C, B, A properties. If you're in a pocket that traditionally has struggled, you're struggling again. There's been a recoupling of tenants going back, living with family or getting roommates, and that's driving some occupancy down in certain markets. But as a whole, experiencing job growth, population growth, and supply is diminishing. And so we think now is a great time to buy in, and you'll be able to enjoy some rent growth now and in the future before we overbuild again.
So speaking of that, so it seems like, Houston, Dallas have been kind of neck and neck, Bob, for, my entire professional career as far as kind of delivering among the top markets in the country in new supply. And seems like the last big run up, Dallas, was not the top, top one or two entire country, and for just, chunk units, maybe not on a percentage basis. That's Austin, Nashville, where I kind of took that prize. But the last, kind of post-COVID push, Houston seemingly was about half off of what Dallas was on the supply. So it seems like for a change, your fundamentals are a little bit more stable than Dallas has been, and that's not historically my perception of your market. How is that correlating right now for kind of your Class A fundamentals, and I know you talked about your workforce housing, or you alluded to the workforce housing pockets being problematic. So maybe kind of expand upon the tale of two cities and talk about the supply or lack thereof.
Yeah, so typically we're about 25,000 units delivered a year, and we absorb right around 24, give or take. From what I can tell and what our research is showing us is we're going to be around 15,000 coming over and delivering in the next year, which is 10,000 off traditional norms. Now, our proposed has gone way up, but it's hard to quantify who's actually going to get theirs done and not. They kind of just sit and stay as proposed for a good while. I know that developers are starting to tie up some sites again, which that'll be another 3 or 4 years before they actually get them stabilized in full. So we've got a lot of demand just from the port, and the growth of just Houston as a whole and all the surrounding area just seems to just keep growing and growing and growing out in every direction. Unfortunately for me in traffic, I think Houston's going to continue to expand exponentially.
And then over to Central Texas, San Antonio specifically, Zar, what do you see in there? We own 5 assets on the market, ranging from, new kind of Class A to kind of A minus, let's call it. We don't really own any workforce housing in San Antonio. What do you see? It seems like their market's been pretty soft from a fundamental standpoint, as I think you alluded to in your intro. But it does seem like new supply is falling off a cliff, kind of similar to what Bob was talking about in Houston. And it seems like it's going to be many years before, once this kind of current wave of deliveries goes, before San Antonio starts delivering multifamily product at scale. I got to think that, 26, 27, 28 are all going to be pretty limited years for new deliveries, in particular in San Antonio. I don't know if you have any thoughts around kind of the new product and workforce housing, kind of the dichotomy between the two.
So the new product, I think, is at its best entry points. We're seeing a lot of things that were trading for 185 a door that were 90s, 2000s product is now whispering, particularly in West, 135 to 110. And just there's been so much pressure, the Class A rents, specifically West San Antonio, that are experiencing pretty drastic drops we've heard upwards of 10% declines in rental rates. And then on top of that, call it 7-8% concessions, which is 6 weeks free to get to that new absorption. And a lot of that is very commoditized product. Any of the product in the city that's near La Cantera at the Rim is performing well because they've already gone through a lot of those good sites have already been developed. And so you have sites that are hard to replicate in La Cantera and 1604. Downtown, it's starting to feel a lot of new excitement fundamentally. So you're seeing demand increase, but it's the majority of the deliveries are happening in West San Antonio. But oddly enough, while we've seen drastic take prints on reductions in rent, we're actually seeing trade outs now moving up 4%. So they've almost dipped enough to where the trade outs are moving up 4% on either renewals, but there was an endless amount of supply. But what's oddly enough happening is that we had the most demand relative to a percentage basis of any of the Texas markets, but it's also fared this way throughout any recessionary times, because you'll see that San Antonio doesn't print the headline news jobs, but the most in-migration from anywhere across the state has happened here. We're just not getting the corporate relocations or the tech corporate relocations. We're getting the 30 to 50 person business that's relocating from LA permanently. So we have a lot more San Diego and LA permanent moves, and a lot of that's going to go into that commoditized housing workforce, or it's going to go into single family homes in the city. So the absorption we feel pretty positive about over time, because the least likely to get capitalized for new construction is a San Antonio deal. When things just start to look positive in Austin, that deal will get capitalized. Somebody will be excited about equity, and somebody that went to UT or all of those places will get capitalized with new construction, whereas San Antonio the equity is going to move way slower. So we feel like your back end of your delivery pipeline is going to be even more muted. You can get deals done, but institutional equity is unlikely to re-enter new construction, and it's usually the slowest to enter. So we feel confident about deals not being capitalized for much longer for new construction.
And what do you kind of see for 2025? Are you foreseeing rental rate growth, marginal rental rate growth in San Antonio market wide of 2025?
They're saying that there's going to be 4% rent growth. My developer friends don't feel that way right now. The data and the statistics say that is the case, but I think everybody's just trying to get heads in beds here. So I think while the AIs are saying that they're pointing towards rent growth, there's still human intervention to get that conversion to a permanent loan. So they'll drop rate just to put heads in beds. And I think you're going to have that human conversion that's not going to make all the decision. It's the developer saying, I can't pay this pref at 18% and still be alive. So like drop the rate and let's just go to refi as soon as possible. And that's what we're seeing is rate drops so quickly, and it's not as scientific or data driven as everybody would feel. It's really more capital pressure on the back end to get to completion.
And so, for maybe either of you, what are you guys kind of feeling for like investor sentiment right now? We just talked about from MHC, and it was a little more negative. I think was kind of my takeaway from a lot of the owners that I spoke with, and maybe even some of the brokers in Texas, which is where we all focus. Just I think the Fed cutting in September, but the Treasury yields going up at the same time. I think that was kind of what everyone was kind of hanging their hopes on. We get a rate cut, then life will get a little better, and it kind of was a little worse in a lot of ways with the Treasury yields going up. What are you kind of feeling for like investor sentiment, bid-ask spread between buyers and sellers? Any thoughts around there?
So in Houston, we met with both owners and buyers or sellers. Well, not sellers now, but owners. A lot of people are looking to upgrade their portfolio. Most of the transactions that we're hearing about are motivated transactions. A lot of the stuff that we're working on has to do with a change in business plan or life goals, whereas these people are long-term owners and they have equity, and they're just converting from older properties to newer properties, or they're just exiting the business completely. But there's definitely some lender motivated properties starting to trickle out. Everybody wants to buy. Nobody's 100% sure what their equity wants in order to pull the trigger, but everybody's full and all the lenders have money. And so they want to get money out. It's just a matter of figuring out the right deal for it. A couple of deals have gone down recently where, they went at or near exactly what the 2021 investor has into it, which is a good sign. And I think some of these funds, which I'm in a few of them, they've got our money and they're not paying any returns. They're starting to get more aggressive. And I think that it's just a strategic time to be nagging certain owners and certain brokers to be in front of the opportunity at the right time, because it's just hard to forecast when that exact time is going to be. But at some point, some of these owners are just going to decide to sell at market or, close to it.
So what do you see like on your bid-ask spread on buyer seller? What's like actually transacting right now?
So what's actually, I had a really good 2024 relative because I wasn't chasing what the buyers wanted. I was chasing where the problems were, because problems typically clear first ahead of profits in these odd parts of the market. And so most of the stuff I was chasing was very distressed. People wanting to preserve their credit worthiness, being able to do loan assumptions with modifications. And that was the business that was the must trade, goes cheap. And then, as we always say, the trash dumps first, and then the rest of the market starts to recover. But until the trash dumps, then the market doesn't recover. So I think that was a good move for 24, 25. My anticipation of two places that we're going to do is we're going to still keep doing the trash dump, but we also believe that the developer who is getting eaten up by their pref in the Class A space. They were, in our anticipation, a year behind all of the distressed value add sellers that were already over leveraged, because the capital stacks are formed is they have to basically put their equity out first, then use the debt to build the remaining, and then also the remaining dollars are the interest carry. So they were already a year behind everybody else. So we didn't really chase that last year, but this year it's a big portion of our chase. The hard part there is that in order to enter there, you have to enter at either where the pref is located as the position or up against a recapitalization. And that capital, unless it can get recapitalized with some sort of refinance position, which I think in today's moment is unlikely to happen unless it's, or at least cash neutral, the developers may dump at getting their money back on just garden product. We believe that in Austin, people will get saved just because it's maybe not saved, but they're not at credit worthy risk at that point as a developer, because there's somebody in between the capital stack that will perfect a trade, either whether it's buying partnership units or buying some position. In San Antonio, it's one of the last places that people want to go do a more strategic acquisition. They don't want to enter the entity or enter in as mezz or pref. They want to enter as just their own equity. So we think that there's less likely chance that developers that are doing commoditization work on the exit to be able to be saved by capital. So we think that the entry point there is the developers that are building garden product right now. And we think this is the year that they're going to make decisions.
You guys talked a little bit about immigration, just a large demand of folks coming into Texas. We saw a change of leadership at the very top, and whether it was legal or illegal, we've seen a lot of people start to go back into south of the border, even north of the border. And I remember this back in 2008, 2009, 2010, where the economy was kind of shutting down and people in some of these properties were actually leaving Texas and going back home, wherever they came from. They would empty out some of these large buildings that we had loans on. They would take the occupancy, which was at 99 to 102%, and bring it all the way down to 90%, because a lot of these folks, they weren't all by themselves, but their whole family lived with them in all the units in the property itself. Are you seeing anything of, maybe it's just too early right now, to some of these buildings being cleared out or occupancy falling just because of immigration coming down on a lot of these folks that have probably been our good tenants for the last, say, 4, 5, 6 years? Any repercussions? Have you heard anything that's concerning?
See, one of the things that we were talking to lenders about that they weren't underwriting for was policy change and ICE raids, because people don't just leave on the first couple of months. You start to see delinquency pile because they're not going to leave unless they have to. And so we start to see residents coming to the office saying, we're unlikely to pay. We're probably going to skip because we need to have enough capital that if we get deported, that we have money in our pocket to go somewhere else, because we were hearing that employers were seeing 50% at the restaurants and maybe 30% to 40% at the construction sites starting to just not show up to work for fear that those were the locations that ICE was going to be targeting. Even if they did or didn't target those sites, just the threat of it made people not show up. And we're starting to see this month delinquency as a cautionary thing we're hearing from investors on workforce product, that they're seeing delinquency piling up a bit. Now that may go through the wayside, but it depends on what happens in Washington and what they're doing. Going to Guantanamo may get a lot of people concerned about, I better just go home, because nobody wants to end up in Guantanamo as a holding area.
Bob, what are you seeing down in Houston? Any conversations you're having with some of the developers or owners?
I brought it up with some guys over the last couple of weeks and haven't really heard much about it. In the news locally, there's been a few raids for isolated individuals that have been a problem in the past that have records, but regarding, showing up at sites and just looking at big clusters of people, I have not heard of it.
Zar, go back to like you're talking about retail equity, institutional equity, and we really play in the retail equity space. I mean, we're looking for $100,000, $200,000 syndication checks to go in. The last couple deals that you were part of that you had sold properties to, how are those transactions formed? How are they being formed today? How are people raising money to buy these properties?
Three of those are not. They're classified as retail investors, but it's a lot of the dinosaurs who were last cycle entry points in 10, 11, 12, 2010, 2011, 2012 that became very wealthy over those time periods and then didn't participate really from 17 on because pricing had accelerated so drastically. So people that have been on the sidelines are now showing up. And a lot of their lessons from the GFC was if I go high leverage and just hang out, they've become wealthy already because a lot of them either didn't trade or they just refied their way out of their properties and they have so much equity in them that they're trying to do high leverage. Their returns are when we feel like it, not necessarily when I have to put out a coupon of 5 to 6 current today, but they look at basis as a significant entry point. The least likely trade is somebody that needs a current return of 5 or 6% in retail.
And then, Bob, anything on your side? I mean, how are these deals being formed and funded in Houston in the workforce housing space down there?
Yeah, good question. We've still got some syndicators that have been around and through a couple of cycles that are raising retail dollars. They're few and far between. And, we're spending a lot of time researching who everybody is on the bid sheets, but it's similar names that just kind of stayed within their boundaries even over the last couple of years and put fixed rate debt on properties instead of floaters and just made better debt decisions than everyone else. That being said, it's taken everybody a little bit longer to raise that capital. And everyone's telling me that, their big partners are the ones that they're really worried about, not their small LP checks, because the bigger groups that maybe take up 60 to 70% of their capital stack are the ones that are more affected by whatever's going on in Washington and the mood of the day, I guess.
And then, Zar, who's coming and buying stuff from you? Are they local guys? Are they Texas guys? Are they guys from outside the state? Are they international guys? Where are they coming in from?
We're seeing mainly high net worth individuals that already have positions in the marketplace that haven't been as active over the last, call it 5 years. Those are probably the most active on our bid sheets that actually can close, because the ones that are coming in from out of state, typically the bid ask gap is they want 8 cap and it might be a 6 on a workforce deal or whatever neutral leverage is in San Antonio. So if a neutral agency leverage, so if we're 6.25, well, that's the cap rate of the day of what likely is trading on the bid sheet for workforce. There are some people that there are probably 3 or 4 groups that are playing the opposite of the institutions. They're saying, one of the quotes that I had during NMHC was, I can buy a car is more expensive than buying units in San Antonio right now. I got to pay $75 for 4 doors, or I can buy 1 door for, $65, $70 a door. So it's the only moment in time where I could buy an apartment unit cheaper than I can buy a car right now. So they're very confident in that lull. And some of these old adages are people that have been in the business for a long time, so it's cheap right now.
So, Zar, I'll ask you both this question. I'll start with you. So if you had a few $1 billion and you had to go invest San Antonio in 2025, 2026, where's the value that you're seeing right now that's actually executable like today? Which segment of the market would you be focusing on?
Oddly enough, South Central San Antonio is experiencing the most growth, but has been traditionally challenging for workforce, but is seeing the most rent growth. People believe that it's operationally more challenging than North. but there's also been zero new supply because a lot of the new construction didn't pencil. So you're competing against where all the jobs are growing in South San Antonio, including plants and import-export business and a lot of the big government projects that are getting done, and there's no housing there, whereas everybody is building and building where all the great demographics have traditionally been. So we're seeing workforce demand is actually in the places that, opposite to what Bob's seeing in Houston, is struggling submarkets are struggling now. Previously struggling submarkets are performing well in our marketplace because there's so much government stimulus all the way around the board for places like Brooks or the Port of San Antonio, Toyota's expansion. So a lot of these things that are happening in places that people didn't predict would happen. So it's natural supply and demand. So if you're looking for doing a deal that operates and probably has good fundamentals there, but if I'm an opportunistic buyer, I'd say medical center is really great because there's a lot of commoditization, a lot of people that are moving out, and a lot of challenges with supply. But that's where we're seeing the biggest pricing degradation is an entry point for good traditional locations is Med Center in Northwest San Antonio.
Bob, what about you? You're thinking a few $1 billion a deal. Where would you put your cash in Houston?
So the hardest thing about Houston, which is different than Dallas and San Antonio and Austin, is Houston doesn't have zoning, right? So we're a very across the street sort of market, which means you can be north and be great or south and be okay. And there can be a 10% delta in pricing for rents sometimes. It's a tough question to answer, but there's definitely some really good B properties in our loop that are well located, that are great covered land plays that I'd like to be a part of. And then all of the suburbs have some good opportunities right now to get in on. Katy, despite having a massive wave of new supply, surprisingly, the existing stock is holding up pretty well. Same with north to Conroe. Conroe's booming. They've now changed the density requirements down to 6 units an acre. So new supply moving forward is going to take, you can't build an apartment deal on 6 units an acre at the cost of land these days, right? And then they're having trouble expanding their utilities out to some of the suburban tracts up north. So, which Conroe's just on the edge of the woodlands, and it's benefiting from all of that growth there as well. So,
but generally, would you think new is better, or more forces, more relative value? Excuse me for that way.
Relative values, I think 90s and newer, 90s to 2010 is a really good spot to be right now. If you can find those opportunities, there's only, of the 3,800 properties we have, there's only like 500 properties that were built between 1990 and 2008. That's what everybody's looking for. And most of those sellers aren't looking to sell unless they really have to. It's a good spot to be because you're competing with new development that's got $400 plus premiums over your existing rent. So while the value adds in Houston aren't really underwriting to give you, people aren't paying significantly lower cap rates to get into those opportunities, there is a value add play there, whether it be now or in the future, which the 80s deals and older 70s deals don't really have that right now at all.
Are you seeing any interest? And that's one of my takeaways from MAC was like, there's interest in 80s, but you get to like the 70s or 60s, like, I'm not saying no bid, but like it's definitely out of favor in a major way. Is that what you're seeing down in Houston as well?
Yeah, 70s is definitely really tough, and south of 10's even tougher. When you combine those two, you've got a really tough ask at the moment because of insurance.
For us not in Houston, what was that, or what is that on a per door basis to share a 70s deal south of I-10 ballpark, I guess?
Could be $2,000 a unit.
Well, what was that 10, 12 years ago?
5 years ago, it was probably $450 to $500 a unit.
Just 4x to 5 years.
Yeah, we closed a deal that I have relisted in Clear Lake, which was $900 a unit at acquisition, and 5 months later it was $1,800. And so a lot of people were jumping between master policies and different management companies to take advantage of lower rates, and those have dissipated. Now we have seen it come in 300 or 400 a unit, but some of these 70s deals that are prone to having, they have a bad 5-year loss run history are really blowing out right now. Yeah, it's tough.
Mike and I have walked 1 or 2 units in our career. You guys have walked 1 or 2 units. Any funny stories about walking units? Any things that you've seen besides all the dead bodies every once in a while? Or craziness? Zar, you have a big smile on your face. What is the craziest thing you have seen walking apartment units in San Antonio?
The Ratatouille story, where we're walking units and the property, I guess, had a rat infestation in one of the buildings, and it literally looked like the cartoons. When we walked in, it's like those mouse traps everywhere, cheese, and then rats start coming in and out of the units. And we have wilder, crazier stories than that, but not for public consumption on the wild and crazy. We also had another guy that he was a little wild, but he made us, during COVID, wipe all of our shoes with diapers before we could walk into units when we were doing an inspection, and pulled a gun on us. And so
great.
That's what we charge. What we charge is we're the first ones in the door sometimes.
Yeah, like the SWAT team. Any crazy stories about walking units?
Yeah, I walked into one property where we walked in the door and had a whole bunch of roaches fall on us, like literally, like it was staged, which was pretty freaky. I did sell a vacant building in Midtown one time about 10 years ago, and it had a bank totally vacant. So the basement was the old bank's vault. And so the way I would qualify my buyers is we'd walk down there, and inside the vault was a tiny little chair with a little doll that was missing an eye. Once we got super creepy, once we'd get into the vault, I'd just slap my hands really hard and clap. And if they just scared and wanted to leave, I just knew they weren't going to be my buyer, because it only got scarier with each floor you went up. It was chalk lines and all.
That's the fun about being in multifamily. All these wacky, crazy stories. Sometimes people don't understand the number of guys that do this business in your area. And I'll just pick on Zar, because I've known Zar for a long period of time. Zar works one of the largest counties, I think, in the country. I mean, Becker County down in the San Antonio area. And if you compare like a residential realtor, how many residential realtors, Zar, do you think that are in and around that area? And then how many apartment investment advisors like you are in that area? Give a person just a general idea of how many there are.
I heard there's like 1,000 real estate agents that do residential in San Antonio.
How many again?
There's about 1,000, and apparently 20% of them do 80% of the business. But there's a lot of licensed people. As it relates to the number of brokers, I don't know, we're probably up to 10 now, brokerage houses. A lot of them are starting to dwindle down, we used to have 10, and then there were 10 with 10 team members. A lot of those are starting to fall off now, and we're starting to see some of the originals still hanging out. But we're also starting to see a lot of retirement from some legendary people in the business through this moment in time. And that was, part of our excitement to come here is that it's always easier to move when things are cycling through the market. When it's hot, nobody wants to get out of their chair because they lose more money. But for us, that was one of the considerations, is this is the moment in time. It's easy to make the switch.
That makes sense. Michael, any further questions for the guys before we wrap it up?
No, I appreciate it. I like Zar. I'm never the first guy in an apartment unit when you walk in. I'm always a third guy in behind the maintenance of the broker. So I'm never the first guy in, because you never know what you're going to walk into. So that's a little pro tip when you tour. Don't be the first one in the
Don't
unit.
be the first guy in. And don't wear your best
especially
clothes.
In Texas
either.
where everyone's got a gun. You don't want to be the first guy in.
Yeah.
So.
and always knock on the door before you go in there. Don't surprise these people at all.
Yeah,
please.
yeah. How about Ted Mississippi after Zar walks in, then I'll walk in. So anyway, no, appreciate you guys coming on, and people want to know a little bit more, kind of maybe get on your list and learn about what you guys are selling. Zar, what's the best way to get a hold of you that Bob can follow?
Yeah, call me. My cell is 210-528-0680. And my email is Zar, Z-A-R .Haro, H-A-R-O @colliers.com. You can email me, cell phone or email. I'll usually answer.
Bob?
Yep. So my email is bob.heard, and that's bob.heard @colliers.com. And you can reach me on my cell anytime, 713-542-4916.
And then always remember with Bob Heard, his initials are Be Heard, because he's always listening to you.
Right.
So again, Bob, thanks for spending some time with us. Zar, always a pleasure. Thanks for spending some time. Michael, I'm glad you're back from the craziness of New Orleans. Good for you. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.